Stuck in the grind, wondering if there's a way out? What if building real wealth isn't about luck, but mastering a few simple rules? At Financial Roadmap, we're here to break down the top 10 rules for becoming a smart investor. Rules that don't require you to be a financial expert, just someone ready to take control and break free from the struggle. If you're tired of the same old advice and ready for something that actually works, let's dive in and start reshaping your financial future today. Welcome to Financial Roadmap, where your journey to wealth begins. Rule number 1. Start early and stay consistent. The first rule of smart financial growth is to start as early as possible. Time is your most valuable asset when building wealth. Starting early allows your resources to grow steadily over a longer period, taking advantage of the compounding effect over time. Just as important as starting early is staying consistent. Regular contributions to your savings or investments, whether monthly or annually, ensure you're building your wealth over time. Markets will fluctuate, but consistency helps you ride out those fluctuations and avoid trying to time the market. With regular investments, you'll accumulate wealth steadily, even in the face of volatility. Rule number 2. Diversify your portfolio. Diversification is often referred to as the only free lunch in investing. Why? Because it reduces risk without sacrificing potential returns. By spreading your investments across various asset classes, stocks, bonds, real estate, and even alternative assets like commodities or cryptocurrencies, you create a safety net. If one investment underperforms, others in your portfolio can offset the losses. Diversification isn't just about choosing different asset classes, it's also about geographical and sector diversification. For instance, if you invest heavily in technology stocks and that sector experiences a downturn, your portfolio will take a significant hit. However, if you've also invested in healthcare, utilities, or international markets, you can mitigate that risk. A well-diversified portfolio is a resilient one. Rule number 3. Understand your risk tolerance. Knowing your risk tolerance is critical to crafting an investment strategy that works for you. Risk tolerance refers to your ability and willingness to endure market volatility. It's influenced by factors like age, financial goals, and personal temperament. For example, younger investors with decades ahead of them can afford to take on more risk because they have time to recover from market downturns. They might focus on growth-oriented investments like stocks. Conversely, retirees or those nearing retirement may prioritize preserving capital and generating income through bonds or dividend-paying stocks. The key is to strike a balance between risk and reward that aligns with your unique financial situation. Rule number 4. Invest for the long term. Investing is a marathon, not a sprint. Short-term market movements can be unpredictable, but history shows that markets tend to rise over the long term. Successful investors focus on their long-term goals rather than reacting to daily market fluctuations. Consider this. If you had invested in the stock market 20 years ago and held on to your investments, you'd likely have seen substantial growth despite periodic downturns. The lesson? Patience pays off. Adopt a long-term mindset, and you'll be better equipped to weather the inevitable ups and downs of the market. Rule number 5. Do your research. Investing without research is like driving blindfolded. It's risky and almost guaranteed to end poorly. Before you invest in any asset, take the time to understand what you're putting your money into. Research the company, industry, or fund you're considering. Look at financial statements, management quality, market trends, and potential risks. If you're investing in stocks, ask yourself, does this company have a competitive advantage? Is it financially stable? For mutual funds or ETFs, examine their expense ratios, past performance, and portfolio composition. Knowledge is power in investing, and the more informed you are, the better decisions you'll make. Rule number 6. Avoid emotional decisions. Emotions are one of the biggest threats to investment success. Fear and greed often lead investors astray. For example, fear can drive you to sell during a market downturn, locking in losses, while greed can tempt you to chase after speculative stocks or bubbles. To avoid emotional decision-making, create a solid investment plan and stick to it. Write down your goals, risk tolerance, and strategy. When the market gets volatile, refer back to your plan to remind yourself of your long-term objectives. Discipline is your best ally in staying the course. Rule number 7. Keep costs low. Investment fees might seem small, but over time, they can significantly erode your returns. High fees from actively managed funds, frequent trading, or account maintenance charges can take a big bite out of your profits. To keep costs low, opt for low-cost index funds or ETFs. These funds track the performance of a market index and typically have much lower expense ratios than actively managed funds. Additionally, minimize unnecessary trading to avoid transaction fees. Remember, every dollar saved on fees is a dollar that stays invested and compounds over time. Rule number 8, monitor and rebalance regularly. Building a portfolio is just the beginning. Maintaining it is an ongoing process. Over time, some investments in your portfolio will perform better than others, which can throw off your target asset allocation. For example, if your stocks grow significantly, they might make up a larger portion of your portfolio than intended, increasing your risk exposure. Rebalancing involves selling some of the overperforming assets and reinvesting in underperforming ones to restore your desired allocation. This ensures that your portfolio stays aligned with your risk tolerance and financial goals. Set a schedule to review and rebalance your portfolio, whether it's annually, semi-annually, or quarterly. Rule number 9, stay focused on consistent growth. Consistent growth is key to long-term financial success. Reinvest your gains rather than cashing them out, allowing your resources to grow steadily over time. By reinvesting profits, whether from dividends or other returns, you keep the growth cycle moving forward. The longer you allow this reinvestment process, the greater your financial success will be. Steady, consistent growth is more sustainable and rewarding than seeking short-term gains, ensuring that you're building wealth for the long term. Rule number 10, learn from mistakes and stay educated. No one is born a perfect investor, and even the most seasoned professionals make mistakes. What sets successful investors apart is their ability to learn from those mistakes. Whether it's buying into a speculative investment or failing to diversify, reflect on what went wrong and use it as a learning opportunity. Additionally, staying educated is crucial in the ever-changing world of finance. Read books, attend webinars, follow reputable financial news sources, and consider seeking advice from professionals. The more you learn, the more confident and capable you'll become as an investor. Final thoughts. Becoming a smart investor isn't about having insider knowledge or making bold moves. It's about following time-tested principles that build wealth over the long term. Start early, stay consistent, and embrace the power of compounding. Diversify your portfolio, understand your risk tolerance, and invest with a long-term perspective. Do your research, avoid emotional decisions, and keep costs low. Regularly monitor and rebalance your portfolio to ensure it remains aligned with your goals. Finally, learn from your mistakes and commit to continuous education. If you found this guide helpful, don't forget to like, share, and subscribe to our channel. Together, we can all take steps toward a brighter financial future. See you next time.